Everyone wants to get rich.
Yeah, like Buddhists. They don't give a shit about money. They're wrapped in sheets. They're not buying shit.
Okay, well, most people want to get rich. Long-term disciplined dividend investing, say that 5 times fast, is one of the most surefire and easiest ways to get rich over time. This is not my opinion, this is purely a matter of fact. Unfortunately, most new dividend investors make some serious mistakes early on that result in negative performance in the long term. This is due to deceptive dividends, which is the topic of today's video. More on that in just a moment. You're going to waste your investing career by buying this type of stuff because you can't go back. If you've been watching my videos for a while, you know that I love dividend investing. I've uploaded quite a few dividend videos. I can honestly say that this is probably one of my most important dividend videos that I've uploaded to date here on my channel. In fact, normally I just use one side of the board, but in fact, I've actually taped some paper on this side because we're going to start on this side and go over some quick basics that is going to give us some more context for what I'm going to talk about in this video. So we're going to talk about deceptive dividend yields. And for those of you that have seen my yield trap videos and things like that, I'm going to touch on that, but primarily the meat and potatoes of this are coming up, and I think you're going to really enjoy it. First, let's talk about dividends and how they can sometimes be deceptive. So let's say that you buy a stock that is $100 a share. Can everyone see that? Hopefully, right? $100 a share, okay? Let's say it pays a 5% dividend, which is, of course, $5. Okay? Very clean and simple math here. So you own a $100 share of stock, it pays you $5, that's a 5% dividend yield. Now, next year, let's say this stock drops to $50 per share. That's quite the drop, okay? Now, again, they haven't changed their dividend, they're still paying $5, okay? But now suddenly their dividend yield is 10%. So newer investors might say, oh, well, shoot, the stock price dropped, but I'm getting 10% yield now. But what they don't understand is yield as a percentage is only relevant the exact moment that you buy that stock. Because you purchased the stock for $100. The only way you're getting a 10% dividend yield is if you buy the stock for $50. You have to understand that. The reason why this yield jumped, not because they increased their dividend, the share price dropped. Now, again, those of you that watch my videos, you said, Kenny, you've mentioned this before. And you're right, but we're going to get into why this is so confusing for people. We're going to use a very popular stock, or it's actually a business development company, BDC. This is a very popular investment for newer dividend investors because it pays monthly and it pays double-digit yields. I think right now this stock is about 11.5% dividend yield, which right now newer investors are, licking their chops thinking, oh, I love that. And I'm going to compare it to one of my favorites, NOBL, Noble, which right now has about a 2.5% yield, and I don't think it's ever had above a 3% yield. So just off of these yields alone, newer investors, I'd like you to think to yourself, which one is going to make me more money over time? So with that in mind, we're now going to get to the meat and potatoes of what I want to talk about. I'm very passionate because I don't want people to waste time. Time is the biggest factor in investing. If we waste 5 years, which is the timeline I'm going to show in this video, that's 5 years that we never get back. And with compounding and getting wealthy through dividend investing, time is extremely important. PSEC is a highly leveraged business development company that borrows money and then lends it out to small to medium-sized companies, and they charge more interest than what they're borrowing the money for. So that's called leverage. They're leveraging a ton of what they do within their business model. So let's take the time span of 5 years, and what you'll see on screen right here is going all the way back to July 1st, 2014, when we look at the 5-year chart. And let's say we put $1,000 into PSEC and $1,000 into Noble, and let's say that we reinvested all dividends and all capital gains, meaning we just reinvested and compounded. Well, the share price 5 years ago for PSEC was $10.61, okay? The annual dividend was $1.32, so that's a really high yield. You pay $10.50, you get almost $150 a year in dividends. The average annual rate of return, though, is 1.21%. Now, remember just a few minutes ago on the other side of this board, the yield, just the dividend yield alone, currently, and it was back then as well, is double digits. Why the heck are investors only getting what, I mean, you could get that at the bank, FDIC insured, but you're taking on a ton of risk and you're only ending up with just over 1%. That's sad, especially if it's in a taxable account. Now let's look at the total return. The total return over 5 years is just over 6%. You should be averaging that per year, not over 5 years, right? But this is what PSEC has done. So at the end of the 5 years, your $1,000 has turned into $1,061, okay? The share price has dropped all the way down to $637. Oh, by the way, they've also cut their dividend quite a bit, 45%. You've lost 40% of your principal. The only reason you have over $1,000 is because all of the dividends filling in, the blood that you're bleeding over the past 5 years because the share price keeps going down. And here's where PSEC, really, they've been cutting their dividend as well. So newer investors that own this, they say, yeah, the stock price is going down, but the yield, it's still at about 11%, and that's what I bought it at. But you have to understand, it's going down, and they're cutting the dividend, so the dividend as a yield is staying right at about 10 and 11%. That's why it's deceptive, and that's why it pains me, and I'm 100% serious with this, it pains me when I see newer or even moderately experienced investors buy this type of garbage or promote it to others to buy that type of garbage, and unfortunately they end up wasting their time and their money, and they become dissatisfied with investing, or they don't reach their investing goals. You've only made 1.21% average annual rate of return over the past 5 years, okay? The alpha, all alpha is active investment returns, right? What is this investment making over and above the broad markets or an index, right? So you want to see if you're going to take on extra risk or more risk than average, you want to be able to make alpha, right? This should be a positive number, meaning you're making above average returns, okay? So not only are you making less than what you could make in a CD, which is 100% FDIC insured, okay? You're taking on negative alpha, which means you're not making any more money than you would just investing normally. In fact, you're making less. And then the standard deviation is quite high too. Standard deviation means what are the returns expected to be relative to what they were in the past? How far up and down can they deviate? So the higher this number, the more inconsistent the returns are. So the end share price and the end dividend. So we end up with a 40% loss of principal and a 45% dividend reduction, all because we wanted this fancy 11% yield, which is complete garbage, okay? Now, let's take a look at Noble, which I love Noble. It's full of very boring, very established, very nice blue chip companies, okay? Let's go to the same timeline. Here it is on the screen, okay? Share price was $44.84. The annual dividend was 80 cents compared to 132, okay? And again, it probably had about a 2% yield. And this is where when I post, oh, this is a great one, this will make a lot of people money, newer investors say, oh, that yield is garbage. That yield is garbage, 2.5%. What are you talking about? Well, over the past 5 years, it's averaged over 9%. Total return is 55%, okay? So 5 years, you ended up with over $1,500. The alpha, you're getting better returns than the average, the average index or the broad markets. You're getting more alpha, okay? Standard deviation, it's about 50% less inconsistent on its returns. And the end share price is way higher, and they've increased their dividends. So what do we end up with? We end up with a 50% gain on principal, okay? Also, 80% increase in dividends. All because we look at the actual fundamentals of the investment itself rather than dividend yield, and specifically yield as a percentage. Newer investors that are listening to this, really listen close. Next time you're shopping around for a dividend stock, and I want you to wear a shock collar, okay? And next time you immediately look at dividend yield and you want to go for the highest yield, I want you to shock yourself for a solid 5. And get this high yield garbage out of your mind, because you're not going to make any money with it, okay? Now, people say, oh, did you cherry pick this and pick this? Go pick a good basket of any blue chip established companies, established US stocks, and then go pick a basket of established BDCs or high yield ETFs and do the math yourself. You'll see it. Most of the time, 97 out of 100 of these are garbage, whereas most of these are excellent. So don't think that I just cherry picked these two. This is a great example. Every day I see people mentioning, oh, get PSEC, it pays monthly, it pays monthly. Now, also keep this in mind. This is how terrible this investment has performed in a bull market. For newer investors, that means in positive economic times. So if it performed this bad in a bull market, imagine how terrible it's going to perform in a bear market, meaning a recession or a market that is going down in price. So keep that in mind as well. The whole lesson here is stop losing money by chasing yield. I wanted to specifically make this video because I wanted to show you the actual math and how deceptive that can be. This is why when people say, oh, Kenny, you invest like a 70-year-old man. You own, all these boring stocks that yield 1 or 2%. Well, I've shown many examples of dividend stocks that have been yielding 1 or 2%, but they beat the pants off of these flashy 10, 11, 12, 13, 14% dividend investments over here, which unfortunately kill a portfolio. So again, I don't say this to beat down on anyone. I don't say this to act like, I have everything figured out. I truly do not want you to buy these thinking that this is good, because you're going to waste your investing career by buying this type of stuff because you can't go back. So please, 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 please do not look at dividend investing with yield only. So hopefully the newer investors out there that were maybe going to buy a highly leveraged garbage investment, hopefully this made you do a little bit more research and maybe think about buying something a little bit more safe. And that's what's funny is when you think about it, these usually sport, let me grab a marker. So the interesting thing about this is these investments over here on the surface usually sport a 10 or 11% yield, right? They say, oh, investors say, oh man, I'm going to make 10 or 11%. In reality, they're making about 1 or 2%. And then over here on the surface level, these investments sport maybe like a 2.5% yield, but in reality, you're making almost 10%. So again, really think about the dividend stocks and dividend investments that you're buying before you let time run out. Now, if you enjoyed this content, let myself and YouTube know by hitting that thumbs up button. If you're new to the channel, consider subscribing. If you enjoyed dividend investing videos, I have plenty more where that came from. Thank you so much for watching, and we'll see you guys next video.